Steve, a pleasure to have you join us on Power Lunch West Africa for our
Chris,
end of the
Steve,
year
for
review
having me.
of Nigeria's fixed income and Forex space. So you, during our pre-interview chat earlier, you described the market as eventful. And I'm thinking eventful or remarkable, which way do you want to go?
It's actually both, but for me, eventful.
So when you say eventful, let's try to look at what policies you found in some way maybe to have excited the market positively now or negatively. Shall we start from the positive?
So let's start from the beginning of the year when we had the first rate cut after so many years of MPR being left stable. We had 50 basis point cuts in the first quarter, March to be precise, to 13.5. And actually that signal a kind of dovish stance from the CBN. And we could see the effect of that in the market after the election. Don't forget it was an election year. Things were a bit rough before that time in terms of the way people actually view Nigeria in terms of macroeconomic space and stuff like that. But after that, we've seen quite a lot of flows into the economy. We've seen a lot of FPI, maybe not so much from the FDI space, but we've seen a lot of portfolio investors into Nigeria. We've seen our yield actually moved from the highs of 15% levels, especially on the government papers. I'm talking about bonds now, till the current level they're trading. I think that's a few of the positives. Then we've seen the biggest move during the course of the year in terms of CBN actually coming to policies to say the local players actually cannot probably invest in OMO issuance, which is actually part of their monetary tools, but you actually can just go to NTBs and that space. And we've seen a whopping 800 basis point dropped in 1 year paper from the highs of 14.95 to 6.75 right now, 6.6 level they're trading in the interbank market. We've seen about 400 basis point drop on the 5-year to 10-year paper, trading around 11.5 or 11.6 right now from the highs of about 13 levels before. And we've seen roughly about 250 basis points on the 30-year paper, trading around 14.5 before now, and now trading around for 12.6 to 12.7 levels. I think those are the major events that we've seen this year. We've seen Nigerian signed a pact with African Continental Trade.
The AFCFTA.
Yeah. So we've seen quite a lot of activities this year.
Yeah, it's actually been a series of interventions from the CBN, which of course, like you said, was led by the first rate cut in about 24 to 26 months in the year. Now, following that, one of the what I could call the hottest dogs as far as the CBN's policies and interventions are concerned would also be the CBN limiting participation of local corporates and individuals in OMO bills. Shall we attempt to dissect direct impacts now of these policies on Nigeria's fixed income and FX space? First, from the intervention as in limiting participation of local corporates and individuals in OMO bills, how would you say the market directly responded to that policy?
So it created a lot of confusion, and I think banks are still having issues in terms of settlement of how to separate the NTBs from OMO issuance, because some of them actually have some of those issuance actually have the same maturity. So, but let's move away from that. So look at how the market have traded. Like I said, the supply of the NTBs, which is actually the cycle of about 100 billion, cannot actually feed that kind of demand that we actually have in the interbank market, especially from the PFAs, insurance firms, banks, and small other investment banking firms who are interested in actually investing in this instrument. So what you've seen is that you've seen a kind of disconnect between the yields on OMO and the NTB. And the reason being the fact that the OMO is actually kept constant in the market because the flow is actually coming from the offshore players and banks, while the demands on the NTB space actually increase, which is coming from the PFAs, local players and stuff like that, and other people like that. And which is the reason why, what I explained earlier, we've seen that massive movement in terms of yield drop between where it was trading before the announcement of that policy to the present level. If you look at it in terms of government borrowing, so it means that the government is actually able to borrow cheaper than what it used to be. So the funding will probably come lower going forward if the supply still remain at this level, because there's still a lot of fund out there that actually chasing these papers. But in terms of how sustainable this is in terms of looking at all the macroeconomic space that we are operating in Nigeria, vis-a-vis trying to keep inflation lower. I think we actually might struggle to actually maintain this particular lane for some time.
Talking about sustainability and how we might do that, so we'll still get to talk your outlook in the course of this conversation. So what would you say summarily this tells foreign investors or prospective local investors of the Nigeria's fixed income and FX space?
Well, it just
is it a sit on the sidelines, wait and watch us because we don't know what we're doing, or is it a go ahead, bring the money in, we're waiting, we're ready market?
I think it's more like bring the money in. We want the exchange rate to be stable, and we think these guys are the one that actually can support that. So the question is, which of these particular trinity, exchange rates, inflation, and interest rate do I want to tackle? So maybe the central bank actually sees that with this instrument in my hand, I actually can control quite a lot of stuff. So I need the flow coming from the FPI. If the slow pace in the FDI flow coming to the country, then I need to actually keep that space on. So, and that's the reason why you can explain the reason why you have that elevated interest rate on OMO, and you have that massive drops on the NTBs because of the supply and demand scenario you have there.
So let's look at the loan to deposit ratio, which the CBN has set the deadline for December 31st of this year at 65%. There are talks now in the local media that it could go as high as 70%. First, let's look at how is the market responding to the 75% cap, and should projections of a 70% be real? How will the market take it?
I think the question is, how are the banks reacting to it? Because the banks are actually the ones actually feeling the weight of all these policies. So I think if you look at what has happened between when that circular, when it was actually moved to 60% before, it was say there's going to be raised to 65% by the end of this year. So I think we've seen a lot of credit extension from the banks. How that is going to play out in terms of the earnings and the NPL long run, which is what we need to actually see by the time the financials start coming out by the first quarter of 2020. But in terms of credit extension, we've seen a lot of compliance from there. So we discovered that most of the second to third tier banks have actually been very compliant before that circular came out.
So because now we're hearing that the Deputy Director of Financial Policy and Regulations of the CBN said that the CBN might increase LDR to as high as 70% in 2020. So can the banks take that?
Possible. I think the reason still being that they still want that money to go to the real sector. They still want the banks to actually start doing the main banking, by actually extending money, to grow the economy. The percentage increase from 65 to 70%, that's just 5%. And if most of them actually compliant at 65% at the end of December, I don't think that will be much of a problem. I think the major scenario is because of the credit. I'm not too sure we have that credit bureau that's actually very active to a level where they can actually track some of this money going there. And at the same time, we have less default in terms of payment from all these guys that actually are extending the credits to, which might, eventually increase the NPL of banks.
So upon his reappointment for another tenure, I'm talking about the CBN governor now, the central bank has gone from being the lender of last resort, technically, to being the wearer of many hats in the country.
Yes.
So let's have your overview, your outlook for the banks, or for the fixed income and FX space more directly put in the year 2020.
I think 2020 is going to be very interesting. We've seen our reserves actually drop by about 5 billion from the high of about 44 billion to about 38, 39 levels right now. And we've heard that the CBN governor say that until when the reserve drop below 30 billion or 30 billion, that's when they start getting worried about how the exchange rate is going to go going forward. Whether that is possible, I don't know, considering the fact that the oil price still remains slightly elevated above what the benchmark for 2020 budget is. So 2020 is going to be very interesting in terms of what happened in the global space. So we have some other exogenous factor that's going to determine a lot of things going into 2020. The trade tension between US and China seems to be softening a bit. So depending on how quickly they resolve that, Brexit seems to be it looks like something that's going to happen in the next 1 month going forward, because the fact that the Tories actually won the major general elections in the UK. In the local space, we've seen less borrowing in terms of issuance in government papers and T-bills. We've seen them actually trying to move to international market to borrow. So I don't know. I think at this point it's a bit tricky. Some of these bonds or government papers trading below inflation rate.
So Steve, your assessment as far as Nigeria's fixed income and FX market go, eventful and remarkable to look out for.
Yes.
Many thanks to you for your time and thoughts on the show.
Thank you.